All right, we're going to continue chapter 5. This chapter, we have been talking about this for a couple of lectures, and today I'm going to finish it up and start a little bit of chapter 6. All right, so chapter 5, just a brief review. Last two lectures, we talked a lot about new journal entries. All right, we introduced to you a few new accounts here. The first part on operating cycles, we talked about inventory account a lot. Right? Inventory account, the left side increases just like a regular asset account. The left side increases whenever we have new purchases of inventory from our vendor or the supplier. Okay, so inventory account also increases whenever there's freight charges. Okay, purchases of inventory when freight charges, specifically the freight term, transportation term is FOB shipping claim. And that's the time when purchaser is the party that pays the freight charges, so that transaction will be journalized for purchasing sides. Now on the right side of inventory, we also capture any inventory purchase discount that is the vendor, the supplier, provided us. Okay, so if the seller provides us a specific discount period, and we do make the payment within that discount period, then any purchase discounts will fall under the credit side of the inventory account. Okay, now other cases, if our company purchased something from the vendor, and we inspect the inventory and realize that a part of the inventory is actually not matching with the selling standard that we want for our corporation, or simply the item is not the thing that you ordered, then any purchase returns and allowances also reduces inventory value. Okay, so this week when you review chapter 5, make sure to go over the handout that I gave you 2 weeks ago. The handout compares some of the transactions of inventory purchase cycle and also sales entries. Okay, so when it gets to sales entries, after purchasing inventory, first the goal is to have the inventory sold out to your own target customer. And whenever sales transaction happens, always it increases sales revenue and at the same time reduces inventory. Okay, so any sales type of transaction always has two entries. One entry captures sales revenue, and if it's by cash, then it increases cash at the same time. If it's not cash sales, it's on-account sales, and it increases accounts receivable. Okay, remember we're talking about operating cycle for merchandise company. We have purchases cycle, and then we have sales cycle. So after purchasing inventory, we definitely don't want it to be there in the warehouse forever. We want to make profit out of it. So after purchasing items, then we sell it to our own target customer. This increases sales revenue, and at the same time, we generate cash or accounts receivable. Second entry will capture a reduced level of inventory. Okay, so remember that entry we have one on sales revenue, one on reduced inventory, and cost of goods sold. Okay, so whenever inventory is sold out to customer, this increases cost of goods sold expense. This account here only represents inventory expense. Okay, so just like supplies expense, prepaid insurance expense, this relationship between inventory and cost of goods sold is very similar. And we're just opening up an account to represent inventory that a company has sold out to customer, called a cost of goods sold expense account. So just like a regular expense account, that would increase. Okay, so for sales cycle, after we sell products to customer, same thing may happen. Now, a customer may be inspecting the product and see if it matches with their standard, or whether the item is actually the thing that they ordered. So if that's not the case, if there's sales returns and allowances from the customer, this will be captured under sales returns and allowance contra revenue account. Okay, so remember we have a sales revenue account, we have two contra revenue accounts representing a deduction of sales revenue. Ideally, the situation is where corporation side will be getting the full amount of sales revenue. This is the most ideal case. But in case some situation happened that the item is damaged in the middle, or simply it's not the thing the customer requested, then they will ship back the items to us. We have sales returns and allowances. Okay. Other cases, if we grant customer also a discount percentage, discount period, and they do make the accounts receivable payment on time, within a discount period, then at the same time we will also be increasing sales discounts. So both of these accounts, contra revenue account, it reduces the original sales revenue. At the end, the real revenue that you're getting will be using this main account minus any contra accounts. Okay, so these two accounts may not even appear if the company, let's say, we don't want to grant customer any discounts, we don't tell them any discount period, or if the item that was sold out to them is fully, they're satisfied with it. It's completely the right item that they ordered. It's also at the credential that that's acceptable. But in those cases, we don't have these two accounts. We don't have sales discounts or sales returns and allowances. So only when the problem tells you there are these two cases, then we have the contra revenue accounts open up. Okay, so really for this chapter in the beginning part, we're switching roles from a purchaser, getting inventory in, and then later to a seller, selling items to our own customer. Then we want to know what's the profit that we're getting between the cost of the inventory and the retail price that we're selling the customer for. All right, so assuming that all the transactions related to purchases in the beginning of the month is journalized, posted, then we sold out a few items to customer. Those are also journalized and posted. Then when it reaches the end of the month, just like service revenue, we have adjusting entries. Remember in chapter 3, there's different types of adjustments. For merchandisers company, the same thing. Okay, so those journal entries on adjustments also applies to merchandisers company, but we have one more category of adjustments. Okay, so the prepaid expenses, the accrued expenses, depreciation, accrued revenues, and earned revenues, all of those also apply to merchandisers company. But we have one more on inventory. Okay, because again, this is the account that service type of business do not have, so only merchandisers have this account. So this entry tells us that at the end of the month, at the end of the quarter, or at the end of the year, typically at least at the end of the year, perpetual inventory, the company that uses perpetual inventory system also has to do a physical count of the inventory, the items, and the value at the end of the year to see if it matches with the inventory value that's there in their system. So remember, the feature of perpetual inventory system is that it continuously updates inventory level. Remember we talked about barcodes? Whenever cashier scans the barcode, that action immediately links to inventory account and cost of goods sold. But at the end of the year, a company still wants to make sure that the inventory value that they're disclosing to their user, the financial statement, actually is exact and matches with what they have in their warehouse. So they will do a physical count at the end of the year to make sure the inventory value there matches with their system. But if not, in any cases, if the inventory in the warehouse has a lower level of value compared to what's there in the system, then the difference is here. We journalize this adjusting entry. Okay, so meaning this entry represents that the system, we have $40,500 of inventory, but when we do an actual count of the inventory in the warehouse, altogether only worth $40,200. So this difference is the $300. We bury it into cost of goods sold expense account. We're just assuming that this is a part of the inventory that cost of doing business, we accidentally either had an error in the middle when the cashier scanned the items, or possibly it could be stolen by employees or customer accidentally and we didn't caught it on time. Any cases, if there's a differences there at the end of the year when we do an actual physical count, match it with the system, the differences we capture it in this journal entry. So this entry actually looks exactly the same as the second entry whenever we make sales. And whenever there's sales transaction, the first entry is on retail price, the second entry looks exactly like this. Okay, but this case here, the $300 doesn't represent any sales. It represents the adjustments. So the two numbers differences, one is originally what's the inventory cost there in the system, one is after you do the count, what's actually there. What do we actually have? Okay, so the difference is here, we're bringing down what's listed there in the information system under inventory account, reduce it so it matches with what's there in the store. Okay, so the differences here is what we call inventory shrinkage. We think of this as the cost of doing business. So in some cases, for example, if a customer has, let's say, a grocery store, they have 30 items in their cart, and let's say by accident the cashier missed scan one of the items. So the customer took it back home. Unless the customer took it back to the store, there's really no way to identify whether that item is actually lost in the middle, it's on the ground, or at the customer's home, but it's definitely not in the store. Right? So if they accidentally missed to scan one of the items, that inventory account will not be updated by that item. It seems like the store still has the item on the shelf, when in reality, it's elsewhere. Right? So that's one case, and if at the door they don't have any internal control system that will ring for some of the items that hasn't actually been scanned, then there's really no way to identify this type of error in the middle. Okay, or in other cases in the warehouse, you're just accidentally some of the things that rolled on the floor, and then the janitor came to just sweep it away. So that case is also some of the minor items in size. There's no way to identify these unless somebody realized this event actually took place and went back to look at the camera. So on and so forth. Okay, so this we think of it as the cost of just doing business. We vary the differences. Usually these are minor differences. We vary it into inventory account by reducing it and then list it as cost of goods sold expense. All right, so this is one additional adjusting entry. Besides the ones that we introduced in Chapter 3, for inventory, there's another adjusting entries matching the actual inventory value with the system. All right, let's work on a problem here. So the company here says that they have inventory. The balance there on the system shows you it's $8,000 of inventory. And then they do a physical count at the end of the year. In a warehouse, really the inventory they have is only $7,400. So in this case here, which one of the journal entry will you be adjusting for this company? They're all $600, which is the differences. So which one is the correct? A, cost of goods sold is increased expense of inventory, and then we reduce the inventory expense. So yes, in the reality, we have $7,400. On the system, we have $8,000, so we have to match the system with what we actually have. All right, so this case here will be matching the differences by reducing inventory count, turn it into cost of goods sold expense. Okay, so make sure you understand which account is being reduced. Here it tells you that inventory account, the actual amount on the system, is not the same as what's there. Okay, in some cases, although it's not very, usually the case is that what we actually have is less than what's there on the system. There may also be some error that we flip the case. Okay, if that's the case, then this will be the entry. We will have to increase it. So whichever one is the reality, we have to match up to the reality. For most part, it will be the first entry. And usually what we have there in reality is less than what's there on the system. Okay, this is a problem from Quick Check in Chapter 5. So at the end there's 10 multiple choice questions. This is one of them. Now let's move on to closing entries. So you saw closing entries, one of the problem on midterms. Remember, closing entries, the purpose is to close out temporary accounts. Close out revenues, expenses, and also if there's dividends, we also need to close out dividends. All right, so just like service type of business, we do closing entries the same way. Besides that, there's a few new accounts here we only introduced in this chapter, and we also need to close them. Okay, so first journal entry here, we see sales revenue is being posted on the left side because regularly sales revenue has a normal balance under the credit side. Okay, so whenever you want to close out an account, again, this step happens at the end of the season. After a company does the worksheet, after they do financial statements, then they close some of the temporary accounts to make sure retained earnings matches with the real balance. Okay, so the balance for revenue is on the right side. When we close it out, we will be debiting sales revenue. And then we close it out to the income summary. Now for some cases, as I mentioned earlier, if there's sales returns and allowances, sales discounts, its regular balance is on the debit side. So when you close it out, the purpose is to zero the balance. You'll be posting it on the right side. Okay, so all the sales-related entries, we will put it all together in the first journal entry here. Right, in service type of business, we only have service revenue, and that's pretty much it. Here for sales, there's sales discounts, sales returns that relates to sales, but it has opposite balance because it reduces sales revenue. When you close it out, you have to close all three items. So really what's there under income summary is the net amount of sales. Originally you thought you'll be collecting $169,300, but then you offer discounts to customer $1,400. And also they return a part of the inventory back to you, $2,000. So really what you're getting from them, if it's cash sales later on, you'll be getting $165,900. So that's the net amount of sales, and we want to close this out to income summary. The second entry, also the same as service type of business. We close out all the expenses. Remember, expenses, the regular balance is debit side. So when we close it, we zero it out by posting to the right side. Now the only difference is that we have one additional expense account here in this chapter, cost of goods sold expense. Okay, so the blue ones are the new accounts that we introduced in this chapter. Make sure you understand the direction. If it's an expense account, close it on the right side. Revenue account, close it on the left. Contra revenue accounts are special accounts because it really reduces revenue. So when you close it out, it has the same direction as expenses. All right, so does this company overall, after the transactions, after what's summarized here, do they have net income or net loss? Mine is pretty obvious. Net income or net loss? We have net sales revenue, $165,900, and then altogether the expenses is net income because expenses altogether is not as much as net sales, right? So there's definitely profit in the middle between the two. So overall net income, you will be using $165,900. Make sure you use net sales, not the original sales. Okay, in cases that there are sales discounts and returns and allowances, you have to reduce them. So $165,900 minus $112,800. The differences would be $53,100. So this is net income, and therefore it increases retained earnings. Okay, so when we close out income summary, we'll be posting on the opposite side of retained earnings. Okay, so that underlying number really comes from these two. Net sales minus all the expenses. Now, if the company only has the prior three entries, if they didn't give out dividends, then there will only be 3 closing entries. So here's a case that company decides to give out dividends to shareholders, and this is the total amount that they gave away this season. So in this case, you also need to close out dividends. So just like expenses, dividends regular balance is debit. We'll be closing it out by crediting dividends. The dividends by nature reduces retained earnings. This is like a gift given away to shareholders. Okay, so you'll be debiting retained earnings, reducing and closing out dividends by crediting dividends. Okay, but if some of the problems, if you don't see dividends gave out, then you only have 3 closing entries. So what's the process after closing entry? Financial statement usually comes just shortly before closing entries. So you do financial statements and then retained earnings is already at the correct balance, but we want to match up retained earnings T accounts by doing the closing entry. Right? But it's just a step before our closing entries. It's really close. Adjusted trial balance is a step before financial statements. So we start off beginning balance of all the permanent accounts. We journalize entries, post them to T accounts, summarize balance, do adjusting entries, adjust to trial balance, financial statements, closing entries, and then some companies do post-closing trial balance, but it's an optional step, and then we start all over from permanent account balances, because after you close them, there's no temporary accounts, right? Okay, so then the new cycle starts all over again. Okay, so closing really is, for some of the companies, closing really is the very last step. Okay. Now I mentioned this in the opposite sequence. I'm going to talk about statements, but again, statements usually comes before closing entries. Right? I'm going to talk about the differences of statements compared to service type of business. The red highlighted ones really is the same as what's there on the board. Red highlighted accounts, just the new ones, so you have to know where it falls into financial statements. So for income statement, you will see new accounts, sales. Some companies call it sales or sales revenue. These are interchangeable terms. And then if there are cases of returns, allowances, discounts, it will be listed right underneath sales account. Cost of goods sold expense. This is a very major expense account that service type of business do not have. Only merchandiser business has this account. And usually you would see this account having a value that's a lot more significant compared to other expenses. Okay, because it basically represents the major part of how, major cycle of how this type of business generates profit. So inventory is purchased in and then inventory is sold out. Once it's sold out, it increases cost of goods sold expense. Okay, now the differences compared to this in prior 4 chapters, financial statements, another one very important, inventory account. Okay, so this basically is how a company generates the money from. They purchase inventory, then they resell it. So besides these red highlighted ones, really other accounts are pretty much the same. You will still see accounts receivable, you will still see accounts payable, you will still see furniture, equipment, machinery. The red highlighted ones are the new ones introduced in this chapter. Now earlier in the first 4 chapters, the income statement that we talked about, grouping revenues and then minus all the different types of expenses, that type of income statement is called single step income statement. So meaning that we just have a step of revenue minus expenses and then we arrive at net income. So earlier what you have learned so far, the income statement is called single step income statement. For merchandisers business, a lot of the corporation uses multi-step income statement. I'm going to show this in the next slide here. Multi-step income statement provides some of the subtotals of profit, subtotals of income before we actually get to net income. So basically it breaks down information in more details. So creditors, investors, they can look at specifically after selling inventory without considering other expenses, what's the profit? And then if we consider major expenses, what's the income there? And then after considering all the expenses, what is the final net income for this season? So it provides additional information compared to single-step income statement when there's only net income at the end and you only have a group of revenues and a group of expenses. Okay, so this is what a multi-step income statement looks like. We talked about grouping and providing subtotals. You see that at the end we still want to reach net income. This is the same goal. So for all the income statement, remember we want to get to whether there's income or net loss. So at the end we still want to get to net income. It's just that in the middle we break it down into different sections. Okay, generally speaking, you can basically divide multi-step into three main sections. The first one, we want to get to gross profit. And gross profit, last week I briefly mentioned it. Basically, it's the excessive amount that the company is receiving from customer over what they paid to vendor. So if you look at the numbers there, you see sales revenue in the first line. That's the money that you'll be getting from the customer, right? Cost of goods sold is inventory's cost that relates to the product that you sold out to customer, and gross profit really is the difference between the two. So it's the excessive amount that you're getting from customer that's over the money that you pay to vendor.
Is this like the debit side and the credit side, or is just a...
Oh no, this is the statement. So it's basically the right side is, the left side is a subtotal of it for calculations. So you see the two contrary accounts we list there together, and then you add them up, it equals the right side 3,400. Okay, so left side is just the detail items, right side is a summary subtotal of those items. Okay? All right, so this is an income statement, so it's not the debit credit side. Debit credit will exist for worksheets, right? For statements, usually the left and right, left side is detail items, right side you have a summary of those items grouped all together. Okay, so if we look at the first subsection here, before we get to net income, we calculate gross profit, $75,100. And again, it's only considering the cost of goods sold expense. Okay, not all the other expenses. We're only considering inventory cost expense after we sell it to customer. So first section, we start from sales revenue, and then if there's any contrary accounts, of course, we want to reduce them to represent net sales. And then use net sales minus cost of goods sold. That will give you gross profit. So again, net sales is the retail price. Cost of goods sold is the original cost you used to pay to vendor. Gross profit is the difference between retail price and cost of inventory. So that's the first subtotal. So basically, this gross profit has to be high to a level that enables company to cover all the other expenses. Then company will be able to get to net income. If that part is already weak, then let alone all the expenses, and it's very likely that the company will get a net loss later on. Okay, so having a high amount of gross profit really is a good indicator up front to determine whether later on there's actually net income for the company. Okay, because gross profit is only considering cost of goods sold expense. And you can see in the bottom there's a bunch of other operating expenses to cover, necessary and incurred to help the business run their daily activities. So for example, rental, wages, advertising, any costs related to marketing your product, utility. All of these are necessary costs incurred to support the store, support administrative offices, but that's other than cost of goods sold expense. Okay, so you can see all the other ones really does not exceed the 90,800 there for cost of goods sold. Relatively, they are more minor, these expenses. But still, it has to be covered by gross profit. So you have that 75,100, and you subtract all the other expenses incurred, the major expenses here, which groups to a total of 20,700. And this will give you operating income. Okay, in the next few slides, I'll define what is operating expenses and what are the differences between selling and general. Right? This slide, you just need to know the general structure of the income statement. So operating income considers all the major expenses. After gross profit, after you subtract all the major expenses, then you get the second subtotal, the blue arrow there, operating income, 54,400. Then there's another section, other revenues and expenses. These are even more minor expenses. So if you borrow money, you may have interest expense, or if you borrow money to others, you may have interest revenue, or if you trade assets, later in Chapter 9 we'll talk about gains and losses of trading assets. All the other minor expenses and revenues that doesn't really relate to daily operations on selling the product will fall into this category. Okay, so some businesses may not even have this category, then they will have the same amount of operating income, which equals net income. Okay, but in case there's also other minor expenses and revenues not related to daily transactions, daily selling or purchasing transactions, then we put it under the last category. After subtracting, we're adding it, then we get to net income. Okay, so there's three main sections. First one solely relates to inventory purchases and inventory selling, not considering other expenses. Second one captures all the major expenses that relates to selling the items, selling the products, marketing the products, anything that relates to stores and administrative offices. Third section, minor expenses and revenues. Okay, so there's 3 subtotals that you would see in the multi-step income statement. It gives more detailed information to outside users. Okay, now for single step, this is just a review. If you've learned the single step already, if we group the same information but not using multi-step income statement, just simply group all the revenues and expenses, then it will look like this. Okay, so the final dollar amount of net income would always be the same regardless of the format you use. So previous one, we're just providing more additional information on subtotals. Here for single step, just like how you learn financial statements in the first 4 chapters, you see revenue there in the beginning and then all the other expenses together. So we don't differentiate cost of goods sold expense from others. It's just grouped together. Right, so this is single step income statement. Now contra accounts you still see there subtracted right underneath sales revenue. And then all the revenues, all the expenses are grouped together. The subtotal is here. So you use all the expenses to subtract it from the total revenue to get to net income. Okay, so the net income you see here will be exactly the same as this, just a different format here. Any questions so far? Okay, let's take a look at the detailed definition for these and some of the examples. So operating expenses, remember, is the middle part of multi-step income statement. These are the expenses that we consider relates to day-to-day operations, day-to-day activities on purchasing the inventory or selling the inventory. Okay, we break down all the expenses into 2 categories, selling expenses and general expenses. So just by its name, how it's labeled, selling expenses is closely related to the store. So any expense that you see incurred within the store, the utility expense or the personnel, the people that you hire for the corporation that works actually in the store, or other rental expenses that relates to the store itself, depreciation on some of the assets, depreciation expense on the equipment or assets that is there, actually physically there in the store. Any expense that relates to the store falls under this selling expense category. So we always list selling expenses first, and then we consider general expenses. Right, so these are some of the examples. It's not the whole set, but it gives you an understanding of what falls under this category. So if you're given a bunch of different types of expenses, as long as it tells you it's store related, these are the people, the wages relates to the people that you hire to actually, the cashier there to help you scan the items that customer purchases, or some of the sales representative that's actually there in the store. All of these costs will fall under this category. Okay, remember we talked about freight out delivery expenses? So if the seller, if our company sells products to customer and we agree on FOB destination point, not the shipping point one, this destination, then we are the party, the seller, that is in charge for freight charges. Okay, so in this case, any freight cost that the seller is responsible for falls under delivery expenses. So again, this closely relates to the products, the selling cycle or purchases cycle, then it falls under selling expenses. So as opposed to this, selling expense, the other category is general expenses. So meaning anything that is related to the administrative office's expense. The people that don't actually work for the store but is still working for the corporation, inside the offices, the people that you hire there, again the rental, depreciation expense, pretty much the same category here besides the sales salary there. pretty much the same category, but it relates to administrative offices. Okay, so anything that is not related to the store, but it still relates to daily activities, operation cycle for the business, falls under general expense category. So salary for management level that don't really actually monitor daily activities physically at the store, but in the office. Administrative personnel that you hired, or any type of rental expense that relates to the office, all of this falls under general expense, not the sales expense category. Okay, so this is just the way how we group the information. So remember, financial statements, the more detailed the information is, the better, because people who rely on the statements do not work inside the business. Okay, so we're trying to differentiate operating expenses into the part that closely relates to the store and marketing the products, and other types that relates to offices. So these are different type of expenses. So again, the first section of the multi-step income statement, we get to gross profit. Then we consider all the other operating expenses, selling expenses, general expenses, then we reach the second subtotal, operating income. So after operating income, if the company also incurred other type of minor expenses that doesn't really closely link to daily operation activities, for example, interest expense that you only be paying from time to time either on a monthly basis or quarterly basis, or interest revenue that you're getting from the people that you borrow money to, or other gains and losses on trading long-term assets, which doesn't happen on a daily basis. These transactions, the dollar amount will fall under the other revenue and expense category. So this was the very last line before we get to net income. All the other revenues and expenses doesn't really incur, meaning these transactions don't appear very frequently. They usually are calculated all together. Like interest expense is just interest revenue only periodically. Gains and losses on trading plan assets, this only happens when the assets are retired. So we'll be talking about this in Chapter 9, where when one is traded onto second-hand markets. So these are not very frequently happen transactions. We only group these expenses and revenues at the very last category, right before net income. These are the expenses and revenues that are least related to daily selling transactions or purchasing transactions. All right, let's take a look at the statement again. So upper part again, we have gross profit. After considering cost of goods sold expense, compare that to sales revenue. Again, retail price and cost of the inventory, the differences is what we call gross profit. And then we consider selling expense, anything that's closely related to the store or marketing the product. Then general expenses, anything that is related to administrative offices. Okay, so this is just an example. You may have even more categories under both sections. So after considering operating expenses, those that closely related to selling and purchasing cycle, then this gives us the subtotal operating income. So the difference between this number and the upper gross profit is all the other expenses besides cost of goods sold expense that relates to daily activities. The other minor expense here, you have interest expense and possibly interest revenue, gains and losses on planned assets. After considering them, then you get to net income. Okay, so the differences between these two subtotals is the other revenues and expenses. So again, if companies do not have this category, they didn't borrow money to others, they didn't borrow money from others, they didn't trade assets, they don't have this category, then net income will be equal to operating income. Okay, so it's possible that these two will be the same number. You just have operating income and then you list net income with the same dollar amount if there's none of the other revenues and expenses. Okay, so this is only income statement, but really for the following two statements, the format and everything, all the other accounts is really exactly the same as what we talked about in the first 4 chapters. So statement of retained earnings simply uses net income, and then we add the beginning of last year's, the beginning retained earnings, which is last year's ending retained earnings, and then subtract dividends. That gives you year-end balance of retained earnings. Okay, remember, I'm going to turn, we also had a question there. So year-end and balance of retained earnings is represented on statement of retained earnings. Beginning balance plus new net income minus dividends. Okay, so that updated retained earnings would also appear in balance sheet. And here I just listed the balance sheet asset category because the only difference between this balance sheet and prior balance sheet that you learned is just that we have one new account. Okay, and we still have liability, we still have stockholders' equity, everything else is the same, just that we have a new inventory asset account. Okay, don't forget inventory is a current asset because we constantly purchase it in and then we immediately want to resell it. It's basically on a daily basis. This transaction, this asset account is not a long-term asset. Long-term asset is there in the business for a longer time frame, for more than a year. Okay. Inventory, we basically want this to turn into profit. So it's oftentimes resold to customer very quickly. Okay, the last part of this chapter, we just have a few ratios to evaluate how well the business has been operating in terms of how quickly inventory is being sold out to customer and what is the inventory cycle. So last section here really is just a few ratios to help you evaluate the business condition. You can think of this that way. So gross profit, I briefly mentioned this last week already, just a brief review. Gross profit, as I mentioned earlier, the differences between retail price and cost. We use that divided by net sales revenue to determine a percentage. Okay, gross profit percentage, there's no rule of thumb to these ratios. Basically, compared to the same business prior years, the higher the better. In gross profit, we're understanding the relationship between net sales and the profit you gain between cost and retail price. Okay, so if an item was sold out, net sales is $1,000. If cost of goods sold is $500, then you have gross profit $500, and then you use 500 divided by 1,000. So that will give you 50, right? 0.5, which means for every dollar of sales, you're getting $0.5 of gross profit. So this ratio here, the higher the better. Whether or not the business is doing better, we need to compare it to prior season and also compare it to the same industry. Okay, so it's based on comparison. There's no rule of thumb, not like current ratio or debt ratio. Okay, so other ratios, this is related to cost and sales, the relationship between these two numbers. Other ratios, we want to also understand how quickly inventory is being sold out to customer. So inventory, the longer it stays in the business, the older it gets, and there's also more cost to store it. There's also cost to make sure there's probably insurance premium on the inventory. So the second ratio, rate of inventory turnover, evaluates how quickly inventory is transitioned from the business to customers' hands. So cost of goods sold expense, remember this represents cost of the inventory that's actually sold out to customer. So we want to understand the relationship between that and the average level of inventory that's in the business. So average inventory represents the part that is not yet sold out to customer, and the numerator represents the part that is readily sold out to customer. We want to understand the relationship between the two. This ratio at the end will give you how many times cost of goods sold exceeds average inventory. Okay, Okay, so average inventory, will measure this based on beginning inventory level plus ending divided by 2. We want to figure out, we're not just using beginning level to measure it or ending level. We want to just figure out an average level of inventory that's there in the business, in the warehouse. Compare this against cost of goods sold value. So cost of goods sold represents the part that's sold out. Average inventory represents the part that's there in the warehouse. This ratio, again, the higher the better. Because if you think about it, the higher the ratio is, the numerator is higher than the denominator, and that represents the company actually has been selling selling inventory, turning inventory into cost of goods sold very quickly. So the more rapid this process is, the quicker cost of goods sold the inventory turns into profit. Okay, so once again, inventory, the purpose of purchasing it in. Later on, we want to sell it and to gain profit in between. So the quicker the inventory is being sold out to the customer, the cost of goods sold expense account will be increasing. So this part here, the higher the better compared to average inventory level. So for example, you may have a beginning inventory, let's say $500 of beginning inventory, and let's say your ending inventory is $1,000. So if you average them out, 1,500 divided by 2, that will give you 750. And let's say your cost of goods sold is 1,500. The cost of goods sold would be more than average inventory because remember, we have been constantly purchasing new batches of inventory. So actually, if the ratio exceeds 1, the higher it is, the better the company is doing, because that means the inventory is being turned into gross profit quicker. So in that case, if we have cost of goods sold 1,500 in total, divided by 750, the ratio here for rate of inventory turnover will be 2 times, meaning cost of goods sold is 2 times over average inventory. If next season it reaches 2.1 or 2.2, that means the company has been accelerating the process of selling items to customer. And so the higher the cost of goods sold is, that means the quicker the inventory is being sold out to customer and turning into profit. Okay, so for these problems, for using this ratio, the problem typically will tell you what is the beginning inventory level, what is the ending inventory level, and what is cost of goods sold expense in total. What you need to do is average out inventory, use it to divide cost of goods sold. That will tell you how many times cost of goods sold value exceeds inventory average level. And again, the higher the better. The last ratio here really relates to this as well. Just another angle to look at inventory. So some companies may be evaluating it based on rate of inventory turnover. Some companies may be looking at days in inventory. Okay? Inventory turnover ratio, once you have this, to calculate the following one is really easy. Once you have this inventory turnover rate, remember the 2 times or 2.3, 2.5, you use that ratio to divide 365. Okay, so this tells you on average what is the inventory cycle, the inventory time period that it stays in the corporation. Okay, so if you have 2.3 times, so you use 2.3 to divide 365, it gives you the number of days on average inventory is there in the warehouse in your company. Okay, so if on average it's 159 days, so that's about 5 months. That means on average the inventory cycle from the time point it's purchased in up to the time point it's being sold out to customer, on average it stays in the business for about 5 months. Okay, so as opposed to inventory rate, turnover rate, the higher the better, this part here, since it's measuring the number of days, the less number of days, the better. Okay, because you definitely want the inventory to be turnover to be sold out to customer quicker. So if the turnover rate this year is 2.3, if next year is 2.5, you're accelerating the rate. So the number of days will be shrinking. If next year goes to 1, then you will have 365 days, which means inventory usually on average stays in your corporation for a year before it's being sold out. So that's definitely a red flag, a sign that company is not selling the product as soon as they can. Or it's a sign that they purchased too much inventory. So they have too high level of inventory there. That also incurs the cost of storage, incurs the cost of insurance premium on it. Okay, so turnover rate is a way to look at how quick the inventory is being sold out by comparing cost of goods sold against the inventory on average value. So this part, the higher the better. If you use that to divide 365, days in inventory gives you the cycle of inventory, the time period that it's in the company on average. So the numbers here, ideally, the lower the better. And one thing on all these ratios, keep in mind that it's based on comparison. So you're comparing, there's no specific days that's considered good, no specific turnover rate that's considered good. For each and every industry, it's kind of different. So you have to compare it with your same business and also across the industry. But just a general trend, if gross profit rate it's increasing, that's a good sign. Inventory turnover rate, if it's increasing, that's a good sign. Days in inventory, if it's decreasing, that's a good sign. Okay? Because it represents the number of days inventory is in the company. So the longer it is, that means it's growing obsolete, basically uses up storage cost as well. So you want it to be sold out to customer quicker. The inventory management for merchandisers company actually is very important. Okay, so the coverage is not as much for this course. Other courses you may also be learning what is the right point to replenish inventory, what is the appropriate amount to keep, because having too much inventory, you may have it stayed in your warehouse for too long a period of time. If having too less, you may have customer coming in to purchase something but they don't have the product there. Okay, so somewhere in the middle that matches with your customer's purchasing pace and also how you turn over the inventory is actually very critical and a key to merchandisers company. So these are just some of the ratios to evaluate how well they're doing this. Okay, are they having excessive amount of inventory? Are they having just right? Or are they actually having too less of inventory? That can be actually evaluated by these ratios. Okay, let's work on an exercise. Just by going over the ratio, how to do it, we have to apply it to problem to have a better understanding of this. Okay, so get a piece of paper, your calculator, try to get the ratio for gross profit percentage and also rate of inventory turnover. If you get this last part, if possible, try to also get days in inventory. See if it agrees with the rate that you have here. First ratio here, how do we get gross profit?
Net sales minus cost of goods sold.
Net sales minus cost of goods sold, and how much did we get? For gross profit?
Oh no, 26,000.
26,000, and then the gross profit percentage, we want to know this gross profit and its relationship with net sales amount, right? So net sales amount is $65,000. Gross profit is $26,000. We use $26,000 divided by $65,000. This gives you the information of for every dollar of sales, how much gross profit you're getting out of it. Okay, so gross profit is 40% proportion of the total net sales revenue. Okay, so if last season was 35, or last season was 32, any percentage below that, this season 40 would seem as an increasing trend for gross profit. Okay, the higher the better compared to prior seasons. Now for rate of inventory turnover, we want to understand how quickly inventory is being sold out to customer, how many times cost of goods sold exceeds average inventory level. So it tells you cost of goods sold directly, it's $39,000. An average level of inventory will be using beginning inventory plus ending inventory, added together divided by 2.
4,000.
Okay, so you have 5,000 plus 3,000 divided by 2. This is the average level of inventory, $4,000. Cost of goods sold is the total amount of inventory expense that has incurred in this season. So altogether, $39,000. We're trying to understand the relationship between these two. The higher this is, that means the quicker a company is selling their purchased inventory turning purchased inventory into sales. Okay, so this 9.75 times represent that cost of goods sold expense is 9.75 times over average level of inventory. So this again, the higher the better. Last season was 9 or 8, and this season we have been accelerating the pace of selling inventory to customers. The last season was higher than this, and that means this season we have been slowing down a little. So this problem only asks you about two ratios. If I add another question, days is in inventory, then you'll be using the 9.75 to divide 365 days. Okay, days in inventory we're trying to understand is the number of days average level of inventory is actually in the company. So this part gives you the cycle of inventory from the beginning it's purchased in, on average, how long of a time does it stay in the business before it's being sold out to customer. So if you calculate this, that will give you how much? We'll give you 37.4, and the unit here is days. So on average, it stays in the business for about a month, a little bit more than a month, 37.4 days. And we're using the inventory turnover rate to divide 365 days. So next season, if this ratio, this inventory turnover rate goes up, then this part will go up or down. Not getting the question. If this exceeds to about 11 times, let's say, how would this affect next season in days in inventory? It will go down. Okay, so if this part goes up, the denominator goes up, then the number of days will go down because you have been selling items to customer in a quicker pace, faster pace. Okay, so on the opposite side, if this goes down, the inventory turnover rate is lower next season. If this goes down, then that means the average number of days that inventory is there in the company is longer compared to last season. Okay, this has an opposite direction. Any questions on the ratios for this chapter? So in the following chapters, we'll be introducing a few ratios that relates to that specific chapter. Okay, as we go over different topics, this chapter is on the topic of inventory, so you have some ratios that relates to sales, that relates to inventory turnover rate. Later on in chapter 8 and 9, we have assets, and then liability, and then cash flows. We have other ratios that you'll be introduced to that helps you evaluate transactions that relates to that topic. Okay, but overall, it's just using different angles to evaluate the position of the business in different seasons. Okay, oftentimes these ratios are based on comparison. When you look at different financial statements across different years, different seasons, you can compare the trend of these ratios, whether it went up or down. Okay, statistically evaluate the business's health. All right, that's pretty much the end of chapter 5. I want to spend a little bit of time on chapter 6. Chapter 6 is still on the topic of merchandise inventory. We're going deeper into inventory costing methods. Earlier in chapter 5, we talked about inventory's cost of goods sold expense, basically directly giving you the value of cost of goods sold. So we're going to tell you how to figure that out, how to actually get to this dollar amount. Okay, with this chapter, you'll be introduced different types of inventory methods that helps you understand how do we arrive at that $39,000. Why is it $39,000? Why is it $40,000? Okay, so this goes back to a concept that earlier we talked about purchases. There may be different purchase transactions that occurs on a daily basis. So even for exactly the same item, when you purchase from your inventory, from your vendor, from your supplier, it may not be the same cost every time you make that purchase transaction with your vendor. So for example, if I own a small business, I sell different types of sodas to customer, and I purchase a batch of 1,000 bottles of Coke from my supplier vendor. And let's say average out each bottle of Coke worth about 50 cents, let's say. Okay, this transaction, if it happens January 1st, then I have 1,000 bottles of Coke times 0.5, 50 cents. That would equal the total inventory cost for this batch of purchase transaction. Okay? Let's say a month later I want to replenish the Coke that I have for my customers. And I purchase another 1,000 bottles. Now this time it may not necessarily be each and every bottle having 50 cents. It could be, let's say, 49 cents or 51 cents. Let's say it's 51 cents. Then altogether this purchase transaction, even though it's still Coke, it's exactly the same product, but this transaction has a different inventory cost. It will be 1,000 bottles times 51 cents. The following month, we'll replenish another 1,000 bottles. Say it's 1,000 times 52 cents. So there are different batches of transaction that relates to the same type of product, but let's say when my customer comes into the store, they just randomly pick one bottle, the one that's right in front of the rack. I do not know which one this belongs to. This is the same type of product, and usually it's very costly for companies to keep track of each and every batch of the same product when it's there all together on the shelf. Okay, so we'll be capturing the cost of that particular bottle that company picked, that customer picks out from your store, by different types of inventory costing system. We call them FIFO, LIFO, average costing. Meaning that if we already had a bottle that worth 50 cents and then 151 cents, 152 cents, when a customer purchased a bottle from my company, if I use FIFO, first in, first out, I will be assigning 50 cents to that bottle. Because that bottle I purchased it first, early on in January. As opposed to that, if I'm using LIFO, last in, first out, then I'll be assigning the 52 cents for that bottle my customer picked. Okay, so this is just a way how we assign the cost. Overall, it would be, once the 3,000 bottles are sold out, overall the cost would be the same. It's just for particular sales transactions, what is the cost that we assign to that bottle depends on different inventory costing system that a company is using. Okay, so I'm just referring to one type of product. There's multiple type of products in my store, and if I purchase these products at different timing, different transactions, the cost could be all different. The companies will be applying these different inventory systems to assign the cost of goods sold for that product. So customer A, I may be assigning 50 cents for the Coke. Customer B, if they're purchasing, after I sold out the 1,000 batches, then the 1,001 customer, I'll be assigning 51 cents to that bottle if I'm using first in, first out. Okay, as opposed to that, last in, first out, I'll be using 52 cents for the first 1,000 bottles, and then the 1,001 customer, I'll be using 51 cents for that bottle. Just a way to measure inventory costs, because it's very costly to keep track of each and every purchase transaction for sales transaction to customer, whether they're picking the earlier batch or the later batch, since they're really the same type of product. Okay, so inventory costing is the theme for Chapter 6. You'll be learning different types of inventory methods, and then at the end we want to know at the end how this affects net income. Okay, all of these affects cost of goods sold and inventory in some way. We use first in, first out, last in, first out. This will give us slightly different net income amount at the end of the season. Okay, so the chapter here, we'll start from, first of all, before we go into calculation, we'll start from understanding different principles that relates to inventory. Okay, some of the principles you need to know here that relates to how we report inventory-related transactions on financial statements. There are 4 different principles that's newly introduced in this chapter. The first one here, consistency. So since we're talking about different inventory methods, consistency guides accountants for corporations to use the same type of inventory method along the years. So meaning once the business starts, once the business incorporates, if they decide, of course this usually is management level, will decide together with accountants, if they decide to use one specific FIFO method, you can assume that they'll be using the same method along the years unless they specify this, they disclose otherwise. Okay, so consistency, when you look at financial statements, if you don't see anything disclosed as related to they have changed the methods, you could be pretty confident that they're still using the same method as what they used before in prior years. Because under consistency principle, usually you'll be using the same method to evaluate inventory. And in Chapter 9, we'll talk about evaluating depreciation for long-term assets. They usually have to be using this. They have to use the same method along the years. Now, in some cases, business may have other plans. Strategically, they want to change a method to another one. Then they have to disclose this information, announce it in financial statements, basically. Okay, so the consistency principle guides accountants to use the same method, but in case management level decides to change the method that they think suits their business best in the next season, they'll be disclosing this information in footnote of financial statements. Okay, so disclosure guides accountants to report any information that would possibly change outside users' decision making. Okay, so reporting something that has changed, it could be inventory methods, it could be how companies depreciate long-term asset. So in Chapter 3, we talked about depreciation. That method actually is straight line depreciation along the years. Later on in Chapter 9, you'll be introduced also different types of depreciation methods. If a company changes it, they have to disclose this information in financial statements. Okay, so disclosure concept, the core is that outside users, they need a full amount of information. So anything that has changed, that shifts, needs to be announced in financial statements. Okay, it may not necessarily be anything in a dollar amount, just a line under footnotes that they have changed from FIFO to LIFO, or LIFO to average costing, for example. Okay, but if that statement is not there, if the announcement is not there, then you can assume that they have been consistently using the same method compared as last year's, as prior years. Okay, other principles, we have two more. Materiality and conservatism. Focus more on conservatism here. Okay, conservatism is a principle that guides accountants to, under cases of uncertainty, they have to measure the highest possible level of losses and liabilities. So for example, if the company is involved in a lawsuit case or in any situation that is they're dealing together with government agency or any fraud-related cases, they have to disclose information on potential losses and liability to the highest possible level. Okay, so if this lawsuit case is not finalized yet, that's okay, but this information needs to be disclosed in footnotes so that outside users know what's going on in the business at this moment. Okay, so any lawsuit cases, if the attorney is able to determine a possible loss amount, then that amount also needs to be disclosed in financial statements. So other examples here, if there was a catastrophe that happened, hurricane, earthquake, tornadoes, anything that potentially or readily destroyed a part of the corporation's asset, let's say the realization of the exact amount of losses is still under process, but you still need to let outside users know. If this is the end of the season, you need to let them know what's going on in the business, there's potential damages, and possibly what is the highest level of amount of loss. So basically anything that relates to creditors or investors' capital, anything that will potentially damage their capital that they contributed to the business, those information has to be measured and disclosed. Okay, so conservatism here, I think of this as more pessimistic in a sense. So basically, company do not want to get involved in later on lawsuits from shareholders or creditors saying that they didn't have enough information to make a decision because they don't know about any potential lawsuit cases or any losses that has actually been encountered in the business now. Okay, now any revenues and gains in accounting, we wait until it's really earned, then we disclose this information or capture it. So expenses and losses, even though it's still pending, we disclose this information. Any bad news related needs to be disclosed up front. Okay, anything that relates to gains or revenues, we wait until it's really finalized. For example, if your company wins the lawsuit case, wait until that is finalized, then we disclose this information. Okay, now materiality guides accountants to take care of the significant transactions more compared to less significant transactions. So here you just have to know the general idea. We're not going to go into detail how to determine what is significant, what is not. Basically, it's that dollar amount, let's say $10,000 amount of transaction definitely will be more significant than a transaction on minor supplies that only worth $100 or $200. So accountants will need to make sure that those $10,000 or a couple $1,000 of transactions are being reported, journalized, and summarized correctly. You have to spend more time on making sure those transactions are correct compared to the ones that has less significant dollar amount. Okay, so materiality basically means that accountants need to put more weight on those significant transactions. Usually it's measured by dollar amount in proportion to total assets or in proportion to gross profit.